Okay, welcome to today's webinar. It is on self-direction basics. Excuse me. I think I got a little allergy attack going on, so I'm a little sniffly. But we're going to go over the basics of self-direction today. Many of you, I think, or some of you at least, are in the self-direction masterclass, which is on Friday or Saturday from 9 to 1. So we're looking forward to that. And that's the real class. We'll get really deep into particularly prohibited transactions and the UBIT tax, because we just obviously have more time. But we're also going to spend a lot of time doing examples, different scenarios, different actual deals, how, what paperwork you need, how to structure it, and stuff like that. So that's going to be a great class on Saturday. If you're not registered, we'll talk about that at the end of the class today, at the end of the webinar. I'll tell you how to get involved in that. Okay, so self-direction basics. As always, remember that this webinar is for information purposes only and for your education. It's not meant to be legal, tax, or accounting advice. This is especially true with self-direction. Kind of as a disclaimer, we really don't have a lot of guidance. That's kind of the tough thing about self-direction. If we had more guidance from the IRS on a number of things, particularly prohibited transactions and the UBIT tax, it would be a whole lot easier. But unfortunately, we don't. The IRS typically does not come out in advance and tell you things of all the things that, yes, this works, or yes, that, or no, that doesn't work. They have sort of the laws that are passed by, the US Congress, and it goes to the Treasury Department and the tax division, and they kind of create rules to put into effect laws. But then beyond that, they basically wait around for a problem to arise, and then, or during an audit or something, and then they investigate somebody and somebody challenges it, and then it goes before either a review board or a commission. Very rarely does it trickle up into, major lawsuits. But at that point, the IRS does issue an opinion based on that case. So once there's some challenge to something, and the IRS rules in a specific example, then that ruling is put out there, and we have that example to base our actions on. But again, that example is just that one example for those facts, and we know with those given facts what is right and what is wrong. But if your facts don't exactly match that case, then that may not apply. And honestly, that's the law. That's what lawyers do, is they get a set of facts and circumstances and apply it to the law. And if you have two different lawyers, you can have two different opinions of how those facts particularly apply to the law in that particular situation. So we don't have a lot of information in the IRS concrete, but we do have some good bases for self-direction and how to guide ourselves. And like I said, we'll get more into that in the class on Saturday, but it's important to know in general. Okay. A little bit about our office. I think most of you know what we do, so we'll skip over that. Yep, this is the first one. So self-directing your IRA or 401k, the first thing we should say is, we're going to talk about IRAs and 401ks simply because those cover 95% of everybody's retirement accounts that they want to self-direct. Now, you can self-direct I don't think there's any exceptions, any type of retirement account, including HSAs, health savings accounts. So, and I do have some clients with a greater variety of types of retirement accounts. So just kind of be aware that if you have something, you might have worked for the government with a 403B, I think that's what it is for government retirement plans. You can do those as well. So if you've got other types of retirement accounts, most likely the answer is yes, you can self-direct them. We're not going to cover those specifically because again, they don't apply to most of our clients, but everybody can have an IRA. That's really straightforward. It's very simple. Every human being can have an IRA, including your own children, which is something that a lot of people don't think about, is that they have their own IRA, maybe their spouse's IRA, but you can actually set up IRAs for your kids, and you can self-direct your children's IRAs and grow their retirement for them, even from the day they're born. So IRAs, a great tool. 401k is also a great tool. We're going to talk about that. That's an employer-sponsored plan, but most of you can also do 401ks because all of you are in real estate investing, and as real estate investors, you have your own business entity set up that you're doing your investing in, so that qualifies as an employer to set up 401ks on behalf of you. Okay, so that's the difference really between an IRA and a 401k. An IRA is an individual plan. It is set up by an individual, some human being with a social security number, and they set it up on behalf of themselves. A 401k is an employer-sponsored plan. So an employer, a business, has to set that up under its EIN, and then it's set up for the benefit of the employees. In the self-direction world, what that means is the business, one of your business entities that you do your real estate investing in, that business can set up a 401k trust. It's sometimes called a solo 401k trust. Sometimes it's called an owner's 401k trust. And I think that there's a few other names out there, but it's either an owner's 401k or a solo 401k. It is a trust, so it's a trust document that you get. It's not an LLC, it's a trust. And that trust is allowed by the IRS to set up bank accounts and hold money, 401k money, on behalf of the owners of the company, which are going to, of course, is you, right? It's your company, you set it up, you're the owners of this company, this LLC that you do your real estate investing in, and that LLC sets up a 401k plan, and then the owners of that company can then make contributions to the 401k, okay? So that's the difference between 401k and an IRA. Here's a comparison side by side of the two different kinds of accounts and what you can do in them when it comes to self-direction. And a lot of this is not even just self-direction. This is sort of true about IRAs and 401ks in general. For example, contribution limits. A contribution is when you make you take your own money and you put it into your IRA account, or your business puts it into a 401k account. For IRAs, the limit's about $5,000 a year. So that's as much as you can get in. You can't get in any more than that. Once you get the money in the IRA, you can grow it as fast as you can. And if you want to do flip projects or wholesaling, you can grow it really fast. But as far as how much money you can put in to kind of seed the IRA, you can only put in $5,000 a year. The solo 401k, however, you can do an individual contribution up to about $17,000 a year. And then the business can match it. You can do matching, employer matches. And those of you who work for somebody else, have a day job, and work for a company that offers 401ks for its employees, you kind of understand that you can put in your own money and then your company can match it. And in a 401k, you can get up to about $55,000, $56,000 a year in contributions between you and the business, which of course is also you. Now, on the 401k side, your actual contribution limits are dependent upon how much you're making in that business. So when you set up a 401k, a solo 401k, you want to use your business entity that is generating the most income, because that will allow you to max out your contributions. Okay, we've got clients that have their flipping and wholesaling LLCs where they generate lots of income. That's the one you'd want to use. We have other clients that have LLCs that hold rental properties, And yes, they make money, but again, most people don't generate large amounts of yearly income from their rental properties, right? It's that $200 or $300 per property, sort of net cash flow every month sort of thing, which is fine. You can still use that LLC and you can still set up a 401k. The problem is, your contribution limits are dependent on how much money you make in that company. So you want to use the company where you have the highest income to make the highest contributions. For both contributions, whether it's an IRA or 401k, don't ask me. I say that, like, oh, how much, I get that question all the time. How much can I contribute? How much can I contribute? Always, always, always ask your certified financial planner or your CPA, because it's dependent on your income. It's dependent on you and your numbers, okay? I can't tell you that answer because I don't know your numbers. So anytime you want to make a contribution, and I do this, to this day, when I want to make a contribution to any of my self-direction accounts, I always just shoot an email off to my accountant and I say, here's what I've contributed so far this year. How much can I contribute? He'll kind of estimate things based on where he thinks I'm going to make money during the year. So you just want to make sure you stay within your contribution limits. But again, as a comparison, you can get more contributions into a 401k. Okay, both IRAs and 401ks have Roth and traditional options. We're going to talk about that, I think, on the next screen. Yep. Okay, so they both have Roth and traditional options. That's the same. An IRA typically, if in the self-direction world, not if if this money is just sitting at Charles Schwab and invested in stock markets, that's not what I'm talking about here. In the self-direction world, generally to self-direct an IRA, your yearly fees are going to be a little bit higher than a 401k, and your 401k is going to be a little bit lower than an IRA. Okay, there are yearly fees with both, but typically the 401k has lower yearly fees. IRA, obviously you cannot borrow from an IRA, but as most of you know that have 401ks, you can borrow up to 50% or $50,000 from a 401k. So let's say you do build up your 401k plan, you've got a couple $100,000 in there. You can always borrow 50% or up to $50,000 of that. And once you borrow it, it's personal money. It's personal cash that you can do anything you with. You have to pay it back. There's certain requirements, or talk to your certified financial planner or CPA. But it's a nice little option. Now, most of my clients in self-direction want to keep the money in their 401k and grow it, tax deferred or possibly tax free, as opposed to borrowing it and then, trying to make money personally. But you can, if you want, you can. And that's just a nice option. As far as the prohibited transactions, they're the same. Doesn't matter which one you're using, an IRA or 401k, the same rules apply, okay? If you make a mistake and you engage in a prohibited transaction, in your IRA, you really can, it is possible to lose the entire IRA amount of money. I'm not going to talk a lot about that. That's going to be Saturday, but it is possible for the IRS to essentially liquidate your IRA and fine you up to the value of your IRA, to the point where your IRA is just gone. Okay, so those are pretty bad penalties. So you want to be really careful about those prohibited transactions. They're really easy to avoid. So it's not like you're walking in a minefield. You can stay totally out of the minefield and be totally fine. And then in a 401k, if you happen to do a prohibited transaction, there are some rules that allow you to fix the problem within a year, and it's only based on that one, the amount involved only is based on that one transaction, not the entire account. And so most likely the penalty is going to be much less bad, I think, is the thing. And it could even be down to zero if things are fixed and certain things kind of happen. It's a little more complicated. But the penalties are definitely not as bad in a 401k as they are in an IRA. Okay, the taxes, the UBIT taxes. Again, this webinar is not going to talk a lot about them. There are two kinds of taxes that can apply to an IRA, and there's only one kind of tax that applies to a 401k. And to kind of just describe the difference here, the UBI tax, that's the unrelated business income, that's going to apply to both. But the DFI, that's called debt financed income, that applies to IRAs, but it does not apply to 401ks. So if you buy a seller financed rental property in your IRA, So the IRA bought the house and it owns the house, but it's financed in some way. That means it's debt financed. There's debt on that property. You'll have to pay some taxes on the income from the rent from those rents because that property is debt financed. But if you bought the exact same seller financed property in your solo 401k, then it's all tax free. There's no debt finance tax for the 401ks. Okay, so the taxation is better in a 401k than it is in an IRA. What kind of investments can you make? The same, doesn't matter. You can make the same kinds of investments with either one. With an IRA, if you're self-directing an IRA, if you want checkbook control, you're going to need an IRA LLC. But in a solo 401k, as soon as it's set up, you have automatically immediate control over the 401k funds. So there's a quick comparison of essentially self-directing your IRA or self-directing your 401k. Now let's compare sort of traditional and Roth type of accounts. Traditional is when you make a contribution pre-tax. So it lowers your yearly taxable income. So it's going to lower your tax burden during the year. And in an IRA, you can make contributions up until April 15th, by the way. So you still have a couple more weeks for 2017. So if you still want to make a contribution to your IRA for 2017, last year, you have 2 more weeks to do that. And if you put it into a traditional account, you're going to lower your tax burden this year. Okay, so it's pre-tax. But when you take money out of a traditional account when you're in retirement, and that money comes out, you're 65, 67, whatever, and you're starting to take that money out, at that point, it's taxed as income. So in a traditional account, you save taxes now, but you pay taxes later. In a Roth account, it's the exact opposite. The contribution comes out after your taxable income during the current year. So you're going to pay taxes on that money, and then you're going to put it into the Roth account, and you let it grow. And then when you're 65, 67, you take money out of the Roth account, it's tax-free. Okay. We generally like and recommend Roths, particularly in real estate. You can build up these accounts much more quickly than in other methods. So it's probably going to be smarter to pay taxes now on your income and then take out the money tax-free later. Okay. It does come down, when it looks at numbers and all things being equal and each grows at the same amount, they kind of become a wash. Because if you think about it, in a traditional account, you're not paying taxes now, so you have more money to put in. Whereas if you put into a Roth, you have to pay taxes now. That gives you less money now to pay taxes, so you put less money into the account. And then you've got less to start off with, and so after 10 or 20, 30 years, it doesn't grow as big because you didn't start off with as much money in it. And so I've seen financial planners run the numbers and say, oh, it doesn't matter because everything's being equal. But I don't, there's a lot of other factors that do come into play. In general, we think a Roth is a better tool because it's just, pay taxes now and then take money out tax-free and you don't have to worry about it. But if you're in very, very high tax brackets now and you think your tax rates are going to be lower when you retire, then maybe you'd rather get the tax savings now when your tax rates are really high and then take out the money later when your tax rates are going to be lower. But again, those are differences that you should discuss with a certified financial planner and make this whatever decision works best for you. Okay, so that's your traditional and Roth. And again, you can self-direct both kinds. You can self-direct a traditional IRA, a Roth IRA, a traditional 401k, and a Roth 401k. Those are just the types of accounts within those two categories. Okay, self-directing your IRA. This is a step-by-step of how to get started in self-directing with your IRA. The first step is to open an account with a self-directed custodian. Right now, if you have an IRA somewhere, it's probably with some kind of brokerage house, a bank or a stockbroker like a Charles Schwab, a Vanguard, a Fidelity, or with Bank of America or Wells Fargo. Some custodian is holding the money, because obviously this is retirement money. It's growing, there's tax advantage to it. It's growing tax deferred or tax free, and you're saving taxes by putting money into it. The IRA wants to confirm that there's somebody authorized looking at and controlling this money, okay? So all IRA money has to sit with some IRS approved custodian. Your current custodian is going to be a bank or brokerage. And banks and brokerages are great. They'll let you invest in stocks and bonds and mutual funds and things like that, but they're not going to let you invest in real estate. One, it's too much work on their part, and two, they don't really make any money off those investments. They make money by selling you stocks and bonds and mutual funds. So you've got to find a self-directed custodian. You can Google self-directed custodians and come up with dozens and dozens and dozens of them. And I'll give you some stuff on how to, what questions to ask in a minute. And then you pick a custodian and you open an account. You can usually do it online. It can usually take about 5 minutes. And essentially it's just setting it up, okay? Then once you've got your account set up, you've got to fund it. You got to get the money into it. So how do you get the money into it? Well, you can make a contribution, of course. Like if you're just starting brand new, you can take $5,000 and put it in. That's a contribution. If you've got an IRA money sitting somewhere else with another custodian, you've got to tell that custodian that you want to roll it over or move it over to this new account or this new custodian. And your current custodian is going to have their own forms to fill out, their own paperwork, their own steps and timing and processing. We usually find that that takes anywhere between 2 and 4 weeks for your custodian to move that money. Okay, so fill out whatever paperwork, get that money moved over, and your current custodian will write a check or wire funds or something, and they'll send the money over. Okay. Now remember that these custodians are going to charge a yearly custodial fee. It's either going to be dependent on the number of assets that your IRA owns, and an asset is like a property. If it owns a house, if it made a loan and it has a note and deed, that note is an asset of the IRA. So those are assets, things that the IRA owns, or it could be just based on the full amount value. Okay, and so on Saturday, we'll talk a little bit more about this and how to cut custodial fees. But one of the things you want to ask your potential custodian is how do they assess their fees? Okay, then once the money's sitting in an account, it's in a self-directed custodian account, and now you can make whatever investment you want. If you want to go do something, you have 2 options. The first is you can direct the custodian to make the investment for you. Each custodian will have their own paperwork. They're called direction letters or buy-sell letters or something like that. And essentially you fill it out and you're telling the custodian what kind of investment you're going to be making. I'm going to buy a house, I'm going to make a loan, I'm going to buy a note, whatever it is. Okay, and they're gonna help process the paperwork for you. They'll help you get everything together. They'll make sure it all happens correctly, and they're going to charge you a transaction fee for this, buying of a house or making a loan or whatever it is. They're going to charge you a transaction fee each time. Okay, and you can do as much as you want. You can make as many loans. You can buy houses. You can do whatever you want by directing your custodian to do it. The other option is utilizing an IRA LLC. In this case, what we're going to do, the first step is you need to create that IRA LLC. That's something we do here at the office. It's an LLC like any other LLC, except it's got some special language in it. It is specially designed, and it's designed in a way that allows it to take retirement account money. And so the owner of this LLC is going to be your IRA account. The actual account will be the owner. You will not own this LLC at all. Your IRA will. And so when you create this IRA LLC with your IRA as the member, it's essentially your IRA is going to buy the membership. And when it buys the membership, it's going to move the money over to the LLC. Okay, so step by step, we create the IRA LLC. Once it's created, you direct your custodian to buy an LLC. That's the asset you're going to buy. Your IRA is going to buy the LLC. And so you're going to you're going to fill out their buy direction letters. You have to direct them to do this. And they're going to charge you a transaction fee for this one transaction. But when they buy this LLC, that money is going to go over into the LLC's bank account that you've set up. And then once that money is in the LLC's bank account, you can then direct those investments however you want. And that LLC can buy rental properties, it can make loans, it can do anything else. Okay. So those are the two options. Most of our clients that self-direct their IRAs do utilize the IRA LLC. There is more risk with an IRA LLC because now you are making decisions about how to structure and what paperwork you need and everything else about buying the real estate. And you have to be a little bit more worried about prohibited transaction because you don't have a custodian overseeing everything and maybe asking you questions and helping you along. So you're a little bit more on your own with an IRA LLC, but you're saving those transaction fees every single time. So you can save considerable amounts of money by using the IRA LLC. Okay. Questions to ask your custodian. Okay, guys, if you want, just go ahead and take a screenshot of this screen. And these are just questions to ask. What is your experience? How long you've been around? What types of services do you provide? Do you provide education? That sort of thing. Are you a custodian or administrator? There's actually two kinds of custodians out there. A custodian, and most people that you're going to be talking to are actually going to be administrators. And they're the ones that help process things. And the custodian may actually be a bank or some other entity that is responsible for the money. Some of these self-directed custodians are both. They're both a custodian and an administrator. Those to me are a little scarier. Many of you may know about American Pension Services here in Utah that embezzled $25 million from the accounts of its clients. It was a self-directed custodian here in Utah, and the owner of it decided to steal $25 million. Boneheaded move, but there are people out there. And believe it or not, the custodian was a bank, a local Utah bank. I think it was Utah First or First Utah, one of the two. And then they were just an administrator, but there was something going on between the two of them, and the bank, I think the bank was a lot more at fault than nothing happened to the bank, but the bank was really the custodian who should have been really monitoring this money, and they weren't, because the administrator, which was APS, American Pension Services, they were the ones embezzling the money. So in that case, it didn't really pan out because I think the bank really screwed up. But if the administrator, and that's the people you're going to be talking with, are different than the custodian, that means they keep their money at another bank where there's bank oversight. I think you're one step more secure than if the administrator is also the custodian. So you can ask them that. What education do they provide? How do they make their money, right? Everyone's got to make money, nothing wrong with that. But you need to ask them, how they make their money. Custodial fees, transaction fees, do they base their custodial fees on the value of your IRA account or on the number of assets or both or a combination, etc. Okay. When and where do audits come from? Do they do them internal? Do they have a separate bank? Okay. Ask them about audits. Are your trust accounts and operating accounts at separate banks? Okay, again, I think with American Pension Services, they were one and the same, but there are other custodians out there where the trust account is where your money sits. That's the bank where your IRA money actually sits. The custodian's operating accounts, that's the accounts where their fees go into, where they pay payroll and staff and overhead and rent, stuff like that. So, are those what? Because again, the trust account is your money, the operating account is their money, and we like to recommend getting those in separate banks. How best can I safeguard my assets, and is there anything else you can tell me? So again, just some questions to get familiar with your custodian before you choose one. Okay, so that's self-directing your IRA. Here is self-directing your 401k. The first thing you need to do is create a self-directed 401k trust plan. Again, these are called solo 401ks or owners 401ks because they're basically created to allow 401k accounts for the owners of the business. And for most real estate investors, it works great because most of your LLCs are just you or you and a spouse, and you own the LLCs and you're going to set up a 401k for yourselves. Okay. If you have employees, just get in touch with us. We'll explain how that works. There are ways to set up a 401k. A business can set up a 401k that also has employees, but it's a little bit more complicated if you have employees where you're setting up your 401k. So some of our clients are bigger full-time investors that do have staff and employees. Typically, they'll actually split the companies, and they'll have one company that they're really generating most of their income from, and another company that does all their hiring and staffing and that sort of thing. And so they'll set up the 401k for the entity where they're making most of the money, and that is owned just by them. And then they don't have to worry about their employees. Because if you do set up a solo 401k in a company that has employees, you have to offer the 401ks to your employees too, which means you're now going to be administering and overseeing their 401k accounts, which again can be done, but it's just more work on your part, and most clients just don't want to deal with that. So there are ways around it. Okay, so anyways, you got to set up the 401k trust plan. It takes a week or so, and you'll get this big, huge, thick stack binding of documents. It's about an inch or inch and a half thick. It's a trust. You can take that trust paperwork into a bank. We have some referrals for banks, and they'll open a bank account in the name of that trust. Okay, then you need to fund that account, just like you did with the custodian. Now here, notice there is no custodian because that 401k trust is the custodian. You're actually creating your own custodian here. And that 401k trust is a plan that has been approved by the IRS to hold 401k money. Just like the custodians have gone through a process and been approved by the IRS to be a custodian for IRA money, this 401k trust has been approved by the IRS to actually be the custodian. So once that's set up, you are basically your own custodian in all of this. And that's why you have sort of immediate control over the money. So you've got this trust. The trust goes and gets a bank account. Then you got to get your 401k money into that bank account. If you want to make a contribution, that's great. Call up your CPA, ask them how much you can contribute, and you can just deposit money right into that bank account and call it a contribution to your 401k. If you've got 401k money currently sitting somewhere, you've got to call up that custodian like Charles Schwab or Vanguard or Fidelity or Bank of America and tell them you need to roll that money over to a new custodian. Okay, and again, they'll have their own paperwork, their own timing and stuff like that. Now, note here, if you currently work for somebody else, you have a day job, and your 401k money is sitting with your current employer, 99% sure your current employer will not allow you to roll over your 401k money to this other custodian while you are still employed with them. That's a pretty standard restriction on employer 401ks. So while you are employed with them, most likely you will not be able to roll that money over. If you've left a company, and it's either still sitting with them or they moved it over to a Fidelity or Bank of America, then yes, you can roll it over. That's not an issue. Okay, so create the 401k trust, open a bank account, fund it by somehow rolling over, making a contribution, getting money in there. Now you've got a bank account with money in it, and you are the trustee of this bank account. You or somebody else. When you set up that 401k plan, you do name a trustee. That trustee is like the manager. They're the one that, opens the account. They can write checks. They can sign paperwork. It can be you. You can be your own trustee. We do prefer somebody not prohibited. We'll talk about that in a second. But it is somebody you appoint. And that person has the immediate control over those funds and can write checks that day. And then so you make your investments out of this trust bank account. Okay. Now notice that this trust and this bank account and all your 401k money really doesn't have any asset protection from the investments that it makes. So 9 times out of 10, if you're going to be buying real estate, especially rental properties with 401k money, you're also probably going to need a 401k LLC, which is just an IRA LLC that's owned by a 401k instead of an IRA. But it is a specially designed LLC. And the reason you want that LLC is for asset protection purposes. You don't need it for the checkbook control of the money. You already have that. But if this trust were to go buy a rental property and the rental property is titled in the name of the trust, and then your tenants slip and fall and sue you, they're going to be suing the trust, which owns the house. And that trust has other money in that bank account. So that other money is now at risk because of this one rental property. So you want that LLC to protect as a buffer in between the asset and the rest of the money. If you're going to be making loans, strictly hard money loans from this 401k account, you probably do not need a separate LLC because there's so little risk in a lender ever getting sued. A lender is just a lender with a note and deed secured on the property. They're not involved in lawsuits. Okay, so it depends on the kind of investing you're going to be doing, whether you would need an LLC on top of this or not. Okay. Before I move on, just real quickly, any questions? Haven't seen anyone pop up with questions yet. Let me know. Just type in questions. We've got self-directing your IRA, self-directing your 401k, the difference between the two, or difference between Roth and traditional. So for example, I'll kind of use me as an example. I have a Roth IRA, and it sits with a custodian. Well, it doesn't sit with, I opened it with a custodian. I then created an IRA LLC. My Roth IRA purchased that LLC, and now that money's sitting in that LLC account, and it's doing its own investing. And it's a Roth IRA. And then I have a 401k. And I have 2 accounts with my 401k. And my 401k trust, I have one trust, but it's allowed to hold both traditional and Roth money. So at my bank, I actually opened up 2 separate bank accounts in the name of the trust. Okay, so it's 2 accounts, 1 trust. One account I nicknamed Roth, and the other account I nicknamed traditional. So I put my Roth money in the Roth account and my traditional money in the traditional account, and I keep them separate that way. Technically, yes, they could be all commingled in one bank account if you kept your bookkeeping separate and all that, but I think that's just way too risky and not smart, because it's so easy to open up a bank account and it's free. It is free. It's no fee checking. So I've got one bank account in the name of the trust for my Roth money and another bank account in the name of the trust for my traditional money. And so I do have both accounts, but I only have one trust, and I invest directly out of those accounts. Okay, quick question. What limits are there on the rollovers? Okay, good question. What limits are there on rollovers into either type of account back and forth? Okay. You can roll over traditional to traditional. You can take a traditional IRA and roll it over into a traditional 401k. Totally fine. In fact, that's what I did with my traditional IRA. I used to have both traditional and Roth IRA accounts, but I didn't want 2 accounts at my custodian, because custodians charge fees. Remember, they charge a yearly fee for each account. And so I had a Roth account with my custodian, a traditional account with my custodian. I was paying 2 fees every year. And then I had my solo 401k set up, and I had traditional money in that. So I just rolled over my traditional IRA to my traditional 401k and shut down my traditional IRA account. And so now I only have one yearly custodian fee for my IRA. Okay, that's great with traditional because you can do that. You cannot roll over a Roth IRA to a Roth 401k. Don't ask me why. Doesn't make any sense. You just can't do it. So my Roth IRA was stuck as a Roth IRA, and that's why it's still sitting with my IRA custodian and utilizing an IRA LLC. It's because there's nothing else I can do with it. You can get even more creative with rollovers. For example, I could take that Roth IRA money and roll it over to traditional. But what I'm really doing in that case is taking the money out of my Roth IRA, paying taxes on it, then turning around and putting into a traditional. And at that point, I could put it into a traditional 401k or a Roth 401k. It doesn't really matter because basically I've just liquidated my Roth IRA account and I just put it into a different kind of account. But that's going to be a taxable event in some way. So you can, and there's even like backdoor rollovers that I'm not super familiar with. So there are creative ways of making higher contributions each year and rolling over things in funky ways to make things happen. That's not my job as a lawyer. That is for your certified financial planner or your CPA to help you with, because those can be taxable events. And so you need to talk about what the tax consequences of making certain kinds of rollovers. But like I said, there are some rollovers that are totally tax-free. How about limits and impacts and disadvantages of rolling over a lump sum pension plan in traditional? Randy, I'm gonna probably talk to you after that, or that's probably a better question for your CPA. I don't know what kind of pension plan you have, whether it be a taxable event or not taxable event. So I would say that's going to be a question for your CPA or maybe somebody at your office about the pension plan. Because again, I'm not as familiar with pension plans as I am with IRAs and 401ks, because that's what my clients deal with. So sorry, I can't answer that question, but good question. And it's probably doable. But again, that's I don't know everything. I know a lot, but I don't know everything. Okay. Okay. So what can you invest in now that you've got your money in an IRA LLC with checkbook control, or you've got it into a 401k account? Okay. What are you going to invest in? Well, you can invest in anything you could do with your own cash, literally. There are some things like insurances and collectibles like artwork and that sort of thing that you can't do in self-direction, but my clients don't invest in those kind of things anyways. I mean, my clients want to invest in real estate. That's the entire point of self-direction, because we're all real estate investors. We know the real estate market. We know how to make money in real estate. We want our money out of all those other things. We want it in real estate where we can control the money much better than we can in the stock market. So you can do bird dogging, you can do wholesaling, you can do flipping, you can buy notes and deeds, you can loan money through notes and deeds, you can do shared appreciation notes, you can do fractional notes, period. Anything in real estate, investment-wise, that you can do with your own cash, you can do with your retirement account money. So that's really great. How do you make investments? Well, that really is what we're going to talk about on Saturday. And we'll go through examples of how to actually make the investments, what documentation you need, what paperwork, how to structure it, and all of that. And the reason I just bring this up here is, I mean, think asset protection. Remember, you've got, especially in a 401k, you've got this bank account with, let's say, a couple $100,000 in it, okay? And you want to go buy a rental property, that's great. That's awesome. Go buy that rental property. But remember, you still got to worry about asset protection and protecting the rest of your retirement account assets, okay? Maybe you're going to own 2 or 3 rental properties, okay? Maybe you're going to do other things. So when you think about asset protection, and most of you have taken my asset protection classes, you probably heard me speak a million times on that, gotta think the same things, okay? You wanna protect your retirement account money in exactly the same ways as you protect your own cash, okay? So it is important to think about asset protection and structuring and all that other stuff when making these kinds of investments, okay? Okay, let me see what else we got. Prohibited, okay. Okay, prohibited, we'll do taxes first. The unrelated business income tax. Okay, we'll spend about an hour to an hour and a half just on taxes on Saturday. But that unrelated business, that's going to apply to both. And that's really what we're going to talk about on Saturday, because it is a much longer discussion of when it applies or when it might not apply. But it can apply to really just about anything you do. Flipping, wholesaling, making loans, okay? These kinds of investments, it's possible that the unrelated business income tax could apply. And it is possible that at the end of a year, your retirement account might have to pay taxes. And I want to make that clear because people keep thinking, oh, this is my retirement account. It grows tax-free. You never pay taxes. Your retirement account never pays taxes, okay? Sure, when it's invested in the stock market, those investments aren't taxable to your retirement account, okay? But when you're in the world of self-direction, it is possible that depending on the kinds of investments you're making and how you're making them and how often you're making them, that a tax may apply and you may have to pay taxes at the end of the year, okay? So we'll cover that more on Saturday. The debt finance income is anytime your retirement account makes an investment that is debt financed somehow. A non-recourse loan or a seller financed property, etc. Those can kick in a tax. But it only applies to the IRAs, not 401ks. So again, 401k is a much better vehicle, especially if you're going to be picking up rental properties. So, and we'll talk more about these on Saturday and kind of get into some numbers and stuff like that and what the taxes actually are, okay? With taxes, as we're going to go into prohibited transactions, taxes are taxes, okay? And, there's two things that are certain in life, death and taxes. Yeah, that's true. If you don't pay your UBIT tax, and let's say you're audited and they determine that you owed a tax, then you're just going to have to pay the tax and probably late fees and a penalty, okay? You're not going to get into trouble. You're not going to lose your retirement accounts. You're not being arrested. It's just a tax that you didn't pay, and now you got to pay it, okay? A prohibited transaction, on the other hand, is a bigger deal. This could, you could lose your IRA account with a prohibited transaction. There are things, the general thing that I want to say, because again, we're going to spend an hour or more on this on Saturday. Retirement accounts are like nonprofit companies because they have tax advantages, Sometimes it's pre-tax money, so you're saving taxes now. In a Roth account, it comes out tax-free, grows tax-free. So for the IRS in general, the IRS looks at retirement accounts like nonprofit companies. And there are rules about nonprofit companies, okay? There are certain things that nonprofit companies cannot do. Very similarly, there are things your retirement account can't do because again, it's regulated like a nonprofit. And there are certain kinds of transactions that you cannot do with any kind of retirement account, whether it's 401k, IRA, HSA, 401 or 403b, because of these rules about the nonprofit rules and the tax savings rules and stuff like that. So the general rule is you cannot do business, you cannot conduct a transaction with somebody or something that is prohibited. What's prohibited? You are prohibited. And we're going to start there just real quickly because we're going to run out of time in a minute. You are prohibited to your own IRA account. Okay, so me personally, Jeff, I have my 401k I make hard money loans out of it, and I cannot conduct business with my 401k. So my 401k cannot loan Jeff Brailio money to do a project, because that's a transaction between my 401k and me. My 401k is loaning me the money. Now I'm talking about outside that $50,000, 50%, exemption, but that's actually a loan, and then that money becomes my money personally. But let's say I'm going to do a flip project, and I want to buy a flip, and I want to use my 401k money. My 401k can't loan me the money to do that. Okay, that's a transaction between my 401k and a prohibited person. Who else is prohibited? Spouses. So the account holder is always prohibited. The account holder's spouse is prohibited. Both of their parents and their spouses are prohibited. Their grandparents and spouses are prohibited. Their children and spouses, their grandchildren, their great-grandchildren and their spouses. It's very linear, up and down, moms and dads and children and spouses, legally married spouses. So those are all prohibited people, okay? Business entities can also be prohibited if a prohibited person is involved with them. So you gotta be careful about saying, oh, well, I'll set up this LLC and my 401k will loan the LLC money. Well, if Jeff isn't me, if I'm an owner of that LLC is prohibited just like I am. So you gotta be careful there. Trust me, people have tried to come up with ways around this, and they're always getting busted by the IRS. The IRS knows all the ways you're gonna try and get around this, okay? So who's not on that list? Brothers and sisters, aunts and uncles, cousins, other real estate investors, okay? There are millions, literally, of other people to do business with other than you and your spouse and your mom and dad and your children, okay? So it's easy to stay far away from prohibited transactions and only work with other people that are totally not prohibited, and you are golden, okay? It's super easy to stay away from prohibited transactions and stay far away from the edge of that cliff. Now, do we walk close to the cliff on sometimes? Yes. Are there ways to do deals with someone who's prohibited? Yes, but it has to be done correctly. It is definitely getting closer to that edge. It has to be structured perfectly, and that's what we're going to talk about on Saturday, is how to do deals like with your own 401k money. We're going to go through a great case example of somebody who got busted for doing it, essentially borrowing money from their own 401k and did it incorrectly and got into trouble. We're going to go through everything they did wrong and show you all the ways to avoid, all the things you need to avoid when doing these kinds of transactions, okay? So if you want to stay super safe, which is great, great suggestions to stay super safe, just go do business with somebody else, okay? You can loan me, well, I'm a lawyer. If I'm your lawyer, there could be some fiduciary problems with loaning me money, but in general, I'm probably good to loan money to. Other investors are good to loan money to. But if you're going to start getting a little bit closer to the edge of the cliff, and maybe you want to pool some of your money and some of your retirement account money on one transaction, okay, we'll talk about how to do that appropriately. So that's on Saturday. So that's prohibited transaction. Okay. Any other questions before I finish up? If you're not in, please go ahead and just type questions. On Saturday, that's this Saturday, 5 days, we're doing the self-direction masterclass. It's a live class, so I will be there. It's down at the Larry Miller Center in Sandy, 9700 South, that sort of thing. Everyone knows where that's at. So it's down there on Saturday from 9 to 1. It's not in the same building as Sloria meets. That's the big building with the big classroom. It's actually the one to the east of it, I believe. It's in a different building, but we'll send out an email to everyone that's registered. It's there. Right now, I have not changed it. I was supposed to up the price to $300 in April this week, but it's still at $250. So this little Utah RIA, I don't think that discount is still available, but hey, if you see it and it works, that's great. I haven't turned it off yet, but it's still at $250 for today. So if you're not registered in the Saturday class, and either you are in self-direction now, you have an IRA LLC or you have a 401k trust set up, or if you are thinking about utilizing retirement accounts and self-direction, your own money, or you are thinking about, oh, well, my mom and dad have an IRA, or my uncle has a 401k. They've got a ton of money and they know that I'm in real estate and they really want to make better returns in the stock market and they want to use their money. They want to get in self-direction, then you really want to be in the class. 45 minutes, I can quickly go over the nuts and bolts and how to get started, but to teach you really self-prohibited transactions, to really teach you the UBIT tax, and to really teach you how to structure deals, I need more time. I need 4 hours. So that's what we're gonna be doing on Saturday. You can go to our website, go to the store under live class or live event, and then you'll see all my live stuff that's coming up, and that you can register directly from the website and attend the class. Did get a question. I live in Georgia. Can I take the class online? If you live in Georgia, we will be video recording the class. And so if you register for the class, you will get all the materials and you'll get the recording. So even if you're here live, you'll get access to the recording as well. But if you can't make the class on Saturday, or you don't live in Salt Lake and still want to participate, register for the class, and we will make sure you get all the materials and the video webinar or the video recording of the class. Okay. Is the asset protection of an IRA LLC exposed to all assets and cash of the IRA LLC? When we create our IRA LLCs, by default, we make them all series LLCs. That's just our standard operating procedure. It has been for about at least a year or two now. So it might depend on if we created our IRA LLC, it might depend on how long ago it was done. These days, every IRA LLC is a series. That way, your IRA LLC can do multiple kinds of investments and separate out the liability. So, is the IRA LLC exposed to all assets? It depends on the kind of LLC. If it's a single regular LLC, then yes, it is. If it's a series LLC and you've separated it out by series, then no, they're separated separated out by each series. So just check on that, Randy, and let me know, or I can look it up. But yeah, we always do, and that's why we always do series LLCs now for our IRA LLCs. Is for the asset protection purposes, and most likely our clients are going to need a series anyways. So, okay. I used prior to, and that's possibly, if a couple of years ago it may have been just a standard LLC. Randy, you can do sub LLCs. That's the old way of doing it. We used to do it that way. So we just create sub LLCs. And it also depends on the kinds of investment you're making and the risks, so it kind of depends there. But if you need to chat with me, Randy, and kind of go over things, we can certainly do that. Okay. Thank you, Carolyn. Again, that's it. I'm going to hit stop on the record now, and we'll be following up with you as well. I'll probably give you a call to see if we can get you in the class, so kind of be prepared for that too. So, okay, we'll talk to you soon.